Teledoes, as artificial intelligence continues moving into 2026. The conversation in financial markets is gradually shifting away from experimental use cases toward real-world enterprise deployment, where companies are expected to demonstrate measurable value rather than conceptual promise. And within this context, there are a limited number of publicly traded firms that offer direct AI exposure without the valuation premiums typically associated with mega-cap technology companies. One of which is C3.ai NYSE. AI, an enterprise AI software company that provides AI platforms and applications to customers across industries such as energy, manufacturing, defense, and government. From a market capitalization perspective, C3.ai has historically operated in the small to mid-cap range, and its business model is largely subscription-based, which creates recurring revenue visibility and aligns with long-term enterprise software economics. According to publicly available SEC filings and recent earnings reports, the company has delivered consistent year-over-year revenue growth, indicating ongoing demand for its offerings. However, it is equally important to note that C3.ai is not yet profitable on a GAAP basis, with operating losses driven in part by high research, development, and stock-based compensation expenses, meaning the path to sustained profitability remains uncertain and execution. On the balance sheet side, the company has historically carried relatively low levels of debt, which provides financial flexibility. But ongoing cash burn remains a material consideration if revenue growth does not accelerate or if operating expenses are not better controlled. From an AI growth perspective, C3.ai positions itself as a platform provider rather than a point solution vendor, allowing enterprises to build and deploy multiple AI applications on top of a unified architecture, which could increase customer stickiness and switching costs over time, particularly as organizations scale AI across mission-critical operations. Yet this strategic positioning does not eliminate competitive pressure, as companies such as Palantir and large cloud providers with significantly greater resources are also competing aggressively for enterprise AI budgets. In addition to competitive risks, macroeconomic conditions, government spending cycles, regulatory developments around AI governance, and broader technology investment trends could all materially impact demand for enterprise AI software. Mass homemaking outcomes inherently uncertain. In the short term, C3.ai's stock price may remain volatile, influenced by quarterly earnings results, changes in investor sentiment toward AI, and overall equity market conditions. While in the long term, the company's performance will largely depend on its ability to translate AI adoption into durable revenue growth, improve operating leverage, and demonstrate a credible path toward profitability. It is therefore essential to emphasize that this video is for educational purposes only, does not constitute financial advice, and viewers should conduct their own independent research or consult a licensed financial advisor before making any investment decisions. While C3.ai represents a lower-priced AI stock with direct exposure to enterprise AI and some solid foundational elements, it also carries meaningful risks related to competition, profitability, and execution, making it neither an obvious opportunity nor a company to dismiss outright, but rather one that warrants careful, objective analysis and a disciplined long-term perspective.